Joining me here on stage, we have Rodney Hooper, partner at RK Equity. We have Scott Yarham, raw material sourcing manager at Ascend Elements. We have Amanda Harsas, finance director and company secretary at Atlantic Lithium. We have Simon Gardner-Bond, chief technical officer at TechMet Limited. And finally, we have Thomas Lagree, partner, critical minerals at InfraVia Capital Partners. So we are going to be continuing the critical minerals discussion, but maybe we can just have a quick introduction from each of our panelists, and then we can get into the topics.
Hi, everyone. Scott Yarham, so raw material sourcing manager at Ascend Elements. We're a battery materials manufacturer based out of the US.
Hi, Amanda Harsas, Finance Director and Company Secretary of Atlantic Lithium. We're listed here on AIM and on ASX and on the Ghana Stock Exchange. We have a 36 million tonne lithium deposit on the coast of Ghana.
So I'm in Gardner-Bond, TechMet. We're a private investment company focusing on the critical minerals from mining, processing, refining through to recycling.
And I'm Thomas. I'm one of the partners of that new critical metals fund that we're launching with the backing of the French government. So that's a new initiative, and thank you for inviting me on the panel.
So we do have a few lithium experts here. I think it's great that kind of started the discussion. I thought we could get a little bit deeper across the battery metals and critical minerals. So looking at the kind of key supply gaps that they've been under scrutiny for the past couple of years. Where are we now? Where do you see the biggest gaps coming up? And are we seeing any investment going into these projects, whether it's exploration or development projects, to kind of get the metals needed for the energy transition?
I'll start. So obviously I'm in lithium, but I think one of the, obviously being in Africa, what I can see is that Africa remains unexplored. Supply gaps exist, I think, in low-cost projects. And one of the, beauties of Africa is that you can actually explore, find things, and they are kind of lower cost generally than other countries around the world. So Africa, I think, in general, is an unexplored resource that can actually be taken advantage of for any of these supply gaps. I'm not an expert in non-lithium materials, so I'll look to other parties for that.
I can jump in. I think if we take a step back, we've seen this movie before where prices hit all-time lows, and that's really across all battery metals if you look at cobalt, nickel, and lithium. And that's when investment pulls back, right? You don't have the exploration, and that's what we're seeing right now. We're seeing a lot of mergers and acquisitions. We're seeing some expansions, but we're not seeing that fundamental need and that requirement to actually for new projects. And this is really what's going to happen for really probably the next couple of years, is that sort of apathetic investment community. And when that demand does come up, that's when we see these massive price swings. And that's not good. That's not good for the market in terms of utility over time. So that's where we are today.
Happy to comment on the gaps as well. I mean, for me, the gaps are not only on the supply part. It's a question of bottlenecks more than gaps sometimes. We're moving from the world of the gold dorés and the copper cathodes to very bespoke chemistries. So now it's a question of aligning the right partners and making sure you not only have the supply coming from the mine, but all the steps that are going to the final end users, and combining all these guys and making sure you share the value along the way. So it's more a bottleneck approach than a supply gap approach, in my mind.
And so, in terms of those supply chains and how they're developing, how, where are you finding the biggest bottlenecks at the moment?
Depends on the commodities. On lithium, I'm very happy to have lithium expert on the panel, but the lithium space, it's a matter of making sure you have a product that is going to various end users, and there are various ways of getting to that end users, but it really depends on the capacity that is the overcapacity in place in China, so you have to be sure that you have a resilient, competitive and traceable value chain, and you can leverage on the expectation of the end users, and I'm sure you're talking to the end users themselves. They are looking for traceability and competitivity, so that's, for me, it's more an opportunity than a risk, actually.
And what's kind of really changing is, from 2 years ago, is the focus on low cost. Like we've had lots of parties talk to us And one of the reasons they talk to us is our project is really low cost, low operating costs, so that in these times when prices are low, the mine continues to operate. We've had lots of suspension, mines going into care and maintenance, production cuts, expansion cuts, and the low-cost mines will survive. And that's been a major focus for any investment coming in.
Okay. So maybe we can talk a little bit about this, the pricing volatility and these low prices that we're, that we're seeing right now. So, what are the major implications, I suppose the macro implications of the current kind of pricing dynamics that you're seeing? And, where are you seeing potential opportunities arising? Whether it's commodity or geographically focused.
Well, I mean, the opportunities are in any metal where the price is low. It sometimes baffles me. I've been doing this for almost 25 years. And it just seems crazy that the commodities market still continues to be cyclical, and yet investors still aren't willing to look back just a few years and say, oh yes, it's cyclical. That means it's going to go up again. It's just astounding. I must say, Rodney's charts are incredibly insightful, but stuff like that I feel doesn't help the sort of marginal dollars that need to come in to sort of push the market. If we look around and there's sector specialist investors, they're going to be the ones who understand commodities. They're going to be the ones who are quite happy to take the risk. Thomas is going to do it because he knows the cyclicality market, but he's an expert. You need the generalists to come in to really push the market. And when they see slides, some of the slides like Rodney's put up where the narrative of the slide is, I'm not sure. They'll just say, okay, I'll leave it. I won't. There are other sectors. There are plenty of other sectors that have got loads of growth. I'll go into those. So that's the main problem. The main problem is the volatility and the cyclicality. It's just the lack of understanding or lack of confidence in the cyclicality actually being a cycle that's going to come good again. And so what does that do? What the outcome is? Well, I'm quite happy. We've got 10 assets at TechMet that are going to produce high-quality assets, are going to produce metals in a couple of years' time. I'm quite comfortable there because the down cycle makes it worse. It means that you have all of these suspensions and these closures. And so when you look forward, Ronnie's got some good numbers there on lithium, and that's a prime case where how many other commodities are you looking at, like a tripling of supply and demand in the next 5 years? There isn't one. So how are you going to do that if nobody's willing to invest? And there's, good lithium projects like Atlantic Lithium that just can't generate the interest from the equity side. So that's going to be a problem. We are seeing a step up from governments in terms of funding, more on the debt side than the equity side. So it's not so much of the risk appetite, but I think that's what needs to change. And it's not just in lithium, by the way. You could take rare earths. It's an even worse case.
Look, I think people were burnt by the $8,000 a tonne, which was never actually real. I think our PFS had $1,400 a tonne and our DFS had $1,350 a tonne as the price we use in that. Other companies used $4,000 a tonne, and that was never going to happen. At $1,000 a tonne, our project makes good money. At $1,200 a tonne, other projects will come on board. But maybe this isn't super low. It's actually just lower than maybe the incentive price, but maybe it never should have been that high.
We have a question from the... do you want to go on before we take a question?
But just to add on my comparison between copper, gold, and the new commodities, we tend to try to analyze the long-term lithium prices using the same methodology that we've been using for copper for the last 100 years. But it's fair to say that some of cyclicality is part of the commodity market, so that's a given. Mm-hmm. But some of these prices are weak in terms of the quality of the underlying reporting, for instance, and some of these markets are not mature at all. So it's not cyclical, it's just immaturity than cyclicality at the moment. And that's important. A lot of people, when you look at all the very smart people trying to copy-paste their methodology on supply, demand, and long-term equilibrium price on niche commodities, it doesn't work that well because the market moves very quickly if you add 1 ton or you remove 1 ton.
Lithium's the worst for this, by the way. We've been through what,
Rare earths.
one cycle? Like lithium's been through one cycle? Like, great, you know.
We go through one cycle a year, I think.
Yeah. But I joke to people that if I meet a lithium analyst who's been doing it for 5 years, I've just met a veteran. You know, it's that there's just no expertise in the sector. And it's not analysts' fault per se, it's because there's just been no lithium industry until 5 years ago. So, yeah, are we learning? Yeah, we're going to learn. But there are complexities to that supply chain, complexities to the sales process, complexities to the product that you're producing that people just don't understand yet.
I think it also, in fairness, the rate of growth is so high, nothing's ever had to cope with that. So the smallest tweak, if you remember in 2019, when China didn't have the EV sales growth as expected, it just collapsed the market on tiny volumes. So that's the difficult part. The other is it's the lack of the line of sight. If you do copper, if you do iron ore, whatever, there's a decent futures market that you understand. Lithium is kind of in the dark, and then it's a question of, well, maybe if the likes of Rio and others of that size get involved and then can smooth out what needs to be done, because the smaller players, they just they sell everything they have to stay alive. That's what happened with Altura until eventually it fell over. So I think as it matures, different players will get involved, and that should help it. But you know, it doesn't cover up for the nickel and the cobalt and whatever. Those are well-established industries with changes in technology and so on. So it's really a tough challenge.
Rodney, I love your slides, by the way. I thought they were very thought-provoking. The bit I think I just want some clarification, maybe, you know, just to so that I get my head around it, was the demand side. So not so much the supply side. I think I get the supply side a bit better. But on the demand side, when you were talking about China, North America, and Europe, the way you presented it, no, it's not good or bad. I just struggle to see how they could be positive outcomes for 2025 in terms of upside surprise. Only because in Europe and in US, your ICE cars are cheaper than your EVs. Okay, so that's one hurdle to overcome. Unless the economy is firing, so that's one problem. Second one, tariffs are going to be hit on Chinese EVs for sure, right? So that then the demand side for China is, and well, we got a lot of supply. What are we going to do with it? So they'll try and absorb it as much as they can, and try and find new markets. But in all three categories, I look at it and think, wow, the outlook's not that amazing. I mean, is that fair?
Yeah, look, again, there's moving parts in it. Europe and the US are introducing lower cost EVs, so that will improve. I mean, and I said this 6 years ago, and they said they'll get there, but of course they didn't, is you need to make $20,000 to $40,000 cars. That is where the bulk of autos are sold. They're not selling $60,000, $80,000, $100,000 EVs is logical because there was a lot of sort of label value in the brand name cars. So there was a lot of margin, you could attack it. But it's the 20 to 40, the Toyota Camry, that area, you have to win that war, otherwise you've got a problem. So they are going to do it, but it is a concern because once China is 100% EV, there is no, you know, that's the end of the road, right? So we'll have to see if Europe and the US can push that, and whether Chinese autos can come. CATL has said if Donald Trump says it's okay to make it in the US, they'll make cars in the US. At what price? Or batteries or whatever. You know, how relative cost-wise, you know, we'll see. But you're right, this is the conundrum I'm talking about, is you have a projection, and if you're off by 10% either way, there's a problem in the supply chain.
The worst thing is the raw material costs are so low now. Okay, if they can't beat ICE cars now, how much lower do they have to go before they can? And that's my worry. So if let's say
Again, it's a
lithium was
scale
high,
thing, though. So some of it is scale, but then you need the profits to build that scale. And this is why I'm saying VW and all the rest is a huge flag for me, because who can commit to those? You look at Ford, Rivian, all of them, they lose $30,000 on every car they sell. So how long can you keep doing that? This isn't the SPAC boom of during COVID. We're now in high interest rate environment, competitive. So it is tough. So the question is, I guess, ultimately, and I'll be interested to hear from the rest of the panel, is do you need to make peace with China and work it out? Because if you are going to a world of EVs, they're the guys who've done the scale and done it properly. And to some extent Tesla, but he's chasing other things.
I just think you're being a little impatient, John. Right? Everyone's had 100 years to get a petrol car right. China's got 10 years on the rest of the world, maybe 15, 20 years on the rest of the world getting them right. And lo and behold, you've got a $19,000 euro, was it dollar? Average cost. Smaller engine, smaller battery, smaller car, whatever. But the Europeans are going to go hard at it. Listen, there's a tipping point. And one of the things that I take a lot of heart from when I think about sort of EV sales is go and look up any consumer survey of people who have owned EVs. They are incredibly positive, and those are your salesmen. I only got one last year, and I used to ask a question. I'd done this panel 5 years in a row. I used to ask how many people had EVs, and slowly the numbers would creep up. I finally caved and got one last year. Now my kids are sort of saying, there's no way we'd ever go. What, I need to replace my car. There's no question. Anyway, so the point being that we've got to give the Europeans and the Americans are probably even 5 years, 10 years behind, although they're catching up very fast. To get it right, there are huge technological gains to be made in these items that you're buying. Not least just on the battery, but on the car and the manufacturing, the way that, and then there's the charging networks, how it works. So I think there's a lot of improvement to be made, and that was one of the things I take heart from, that this isn't the end. We aren't static. So I don't think we need to join arms with the Chinese and bring in loads of Chinese EVs and just let that industry be taken over. I think we can do it. And I think the more people will buy and more people will take up, the cost, the sticker price on the forecourt is an issue, but it will get better. But it's not the only reason. It's not the reason people buy a Tesla. Nobody buys a Tesla because it's the cheapest option.
I think just one other point. So what we're seeing as well is that, China, they've been doing it for 15, 20 years, doing it really well. There will be a higher penetration, but they're now partnering with Europe, with the US, with the Middle East. They're actually partnering outside of China to then break into these markets. So it's not just them. Everyone is working together to actually get this done, and that it will be seen as another market to penetrate, and it will continue on. As an EV owner, my family is the same. Like, I've got 4 cars. Well, the rest of my family have 3 other cars, but everyone wants to drive my car.
Yeah.
I think it's also a question of efficiency. It's the question of scale is true, but also efficiency. Our company is obviously heavily involved in the recycling. So production scrap is incredibly high for most of your gigafactories in the Western world. That will get better, and as that gets better, that will bring down the costs. But at the moment, that is probably higher than it's stated officially. So I think that will be one point. Going back on the history of China, they've also been subsidizing all those years. We're right in the beginning of our subsidy story, and even then, a lot of those have been rolled back or even shortened. So there's another thing to take into consideration.
Do we have any other questions from the audience before we continue on? All right, so I thought we could kind of look at some of the, the various technologies for batteries and stuff, and how that kind of impacts, the EV growth, say in China versus elsewhere. I know there was talk about kind of short range versus long range, and the interest that differs by geography. So, in terms of technological risk for looking at various metals. do you think there is a big risk? Do you think there's, key metals that we need to be focusing on to kind of propel the industry overall? Anything that's going to fall out of the way?
Maybe I'll just, before we pass to the lithium, I'll talk about nickel quickly. The problem you have is exponential growth in Indonesia. Right? Indonesia is now over half of your market of production. It has incredible high ESG concerns. And what that means is you've driven the nickel price now where most Western nickel operators are loss-making. We saw BHP obviously exit the market recently, and that was a class asset, really strong in terms of ESG credentials, carbon footprint, and a really high-quality product. So that's gone. That's no longer available. That lessens options for any Western battery maker who's trying to make a really sustainable but also transparent battery, which is imperative right now if we want to move to a green, cleaner technology. So that's one concern, I would say, especially in terms of Western markets. NMCs, so high nickel cathodes, are still going to be predominant. LFP is not only a China story, that's absolutely going to be adopted in Western markets. Whether it takes the majority of market share, it's still yet to be seen. I think a lot of that's going to rely in terms of consumer appetite, maybe range anxiety. I don't personally believe range anxiety exists any longer. But one thing I would say is that we still need a lot of infrastructure in the US and Europe in terms of charging points. And that's why I think the nickel cathodes are still going to remain quite prevalent. But as on terms of LFP, that is going to take away market share and therefore demand for metals like nickel and cobalt.
If I may just expand on that.
It's a lack of charging stations.
Larger charging stations, correct? Yeah, lack of. Yeah, lack of.
Just to react on the semantic technology risks, it can be an opportunity as well. I mean, it's a market that is evolving as expert or smart investors. That's also an opportunity to assess the right technologies of tomorrow, and there will be a mix of chemistries anyway. I mean, if you think about it, 2 years ago, Europe was going all the way to NMC, 100%. That was a bit stupid. Now we feel that, okay, having a balance in the mix of chemistries probably makes more sense. So it's not that much of a risk for me. It's more one of the reasons to have expertise when putting new teams in place, and that's what we're trying to do in your case. And also making sure you keep assessing the technology with a 10 years time horizon. The same is true on the recycling side. I mean, I'm sure you're comparing and contrasting various technologies, and there would be improvements. And there would be, I don't see a full displacement of technology shifting in 2 years' time to a complete new technology. I mean, so for me, it's not that much of a risk. People are saying, technology obsolescence or chemistry. How do you assess that? No, it's an opportunity. I mean, and the more you assess the competing technologies, the better you are in assessing the merits of each of them. So, but and the same is true again on recycling, on processing, on we can discuss the DLE technologies for the lithium as well. I mean, it's not a risk. It's more an opportunity, I feel.
Just going to pick up on one point that Thomas made. He just said one word there that I think people forget a lot, which is recycling. The current situation we're in, every OEM that sells an EV has zero confidence that they can recycle the battery, and the battery is the majority of the value of the vehicle. Anyone who's tried to scrap a vehicle, a petrol or diesel car, soon finds out that it's worthless. In fact, in the UK, you have to pay to dispose of it, right? That's not going to be the case with an EV, but it's not happening right now. It's not really an issue that's really prevalent now because these things are going to live for 10 to 15 years. And we're still selling very small amounts. But the OEMs are selling you, or the car manufacturers are selling you an EV, having to allow for the fact that they may have to dispose of the battery when it comes to the end of its life because it's an extremely hazardous piece of kit. Because they have no confidence in the recycling. SN might be able to help there. But I think there's going to be a bit of a light switch moment there that as soon as the lithium-ion battery recycling industry can get its act together to start rolling out profitably and scale, there will be a change in the structure of car ownership or battery ownership such that they will become a lot cheaper on the forecourt, but you might not own the battery at the end of its life. They're not many people who buy a car straight off the forecourt end up owning it to the end of its life anyway. So I think that's something that will be a major flip in value. It's just not going to happen in 2024 yet. But it's coming.
Mm-hmm. Yeah, my question to you, there's a new technology coming into the battery market, which increase the more mileage and the fast battery charging. does it increase the size of lithium industries or not? The batteries, like CATL come up with the new battery size about 900 miles, and the fast charging, does it increase the size of the batteries? Or if size of battery increase, then obviously lithium demand will increase more. So what effect that will be having the battery market?
There are new technologies that have higher lithium intensity. The question is, what is the cost of those batteries and what market share will they get? So some of the ones are definitely, I think, in the solid state and so on, have slightly higher. But more to the point, probably, Scott, what is interesting, and I know it's an obscure thing, but the truth is, a lot of what was a swing factor in my production models is production scrappage, because new high technology cells have a very low yield rate, whereas LFP's got a phenomenally high yield rate in China. So the talk was, in a lot of the high nickel battery cells had 50% scrap when they start. So that lithium doesn't get recycled and back into the system within the year. So that was causing quite a lot of, whatever you want to call it, synthetic demand in that period. So I don't know, Scott, what do you think the yields will be on these new tech?
Yeah, I don't know, to be completely honest, but I would say in terms of the scrap ratio in the terms of the bigger factories turning on, you're right, it was up at those kind of levels. The problem is as well, when you recycle it, if you don't have the technology, if you're not a hydromet, you're burning off the lithium, right? So that lithium's gone, right? The problem is as well, no one's paying for the lithium in production scrap right now. So if you look at the black mass markets, they're paying for the cobalt, they're paying for the nickel. Manganese is even a cost, aluminium is a cost, copper is a cost. No one's even considering lithium when you go into those negotiations. It's not being considered whatsoever. So that's an issue, right? So it's not being considered. So it's baked in, but it's not something that's unique in its own self. As I say, scrap rates can be as high at the moment, even with quite well-established companies, as high as 10%. The majority of your recycling market is production scrap. I would say over 90% of all your black mass is recycled batteries. That comes from production scrap. That will invert towards the end of the decade as end-of-life batteries come on, but it'll still be small. So probably 2033, I'd say probably more likely. But up until then, it's going to be purely production scrap. So if you don't have relationships with these gigafactories, you're not producing scrap. It's as simple as that.
All right, so I thought we could briefly touch on kind of the impact of government regulations on and the various critical minerals policies that have been arising globally. So, how are they impacting the industry overall? How are they impacting project development, funding, all of that?
Happy to start and comment on the European regulation first, and happy for the rest of the panel to comment on other regions or countries. But certainly there's been a lot of hope that was in the market when the Critical Raw Material Act was enacted in Europe. The reality is that a lot of these objectives are not binding on the industry, so there is a willingness to develop more mining, processing, recycling in Europe. But people were saying, okay, where is the money now? And that's a bit an opportunity for us, launching that Critical Metals Fund with the backing of the French government. Basically, we are attaching ourselves to what should have been a European fund. And we are a private company, so yes, we do have French money coming from the government, but the door is open for other member states or other countries to join forces and hopefully put money to achieve this objective from the CRM Act. On the other impact of the regulation, that was a big question on fast-track permitting. So there is that new strategic project process in Europe that is happening at the moment. Again, it's a bit difficult to read as to what are the criteria that are making a project strategic or not. It feels that a lot of them will be strategic even if they don't have any funding or they don't make any returns. It's a bit difficult to know who is really making decisions. So for me, the European regulation is good in the sense that it is raising the awareness of the sector. You need metals for the energy transition. That was very important in Europe because we're coming from a long way compared to Australia or Canada. And at least I hope that is going through the political landscape in Europe and in the member states. So that's something, at least, raising the awareness, and people now realize that you have metals in the iPhone and you have metals in the car. So that's something, but that's not a lot. And the lack of coordination on the funding aspect can be a concern, because when you talk to product developers, they are facing one big regulation and then different subsidies, grants, funding schemes, and you have to apply for each of them with different templates and deadlines. So it's a very big mess on the funding scheme. So I will hope that there will be more clarity on the funding instrument, either coordinated at the EU level or more visibility given to some of the member states' initiatives. Because money is one thing, but speed of decision is something else as well. And we are just in the middle of having a new commission with a new report for Mr. Draghi that is hopefully pushing some topics again on the commission agenda. But again, time is of the essence. We cannot wait forever. And some of these projects, they are just knocking on the door. We're waiting for the funding and waiting for the permits. So just to summarize, good to have regulation in place, but much more to be done.
I can talk about the IRA, which obviously is prevalent for our business. So Inflation Reduction Act, which was obviously introduced by the Biden administration, we've obviously hugely benefited from that. It is meant to obviously onshore critical material production in the US, not just in the US, but obviously free trade agreement countries, alongside FEOC, so foreign entities of concern, basically trying to wean US domestic supply chains off China dependency. In premise, it has had a huge impact. Obviously, we've seen a lot of investment, billions of dollars into critical material projects. The issue we have is that it does leave for quite a few grey areas in terms of that critical material supply. The problem is that you have two parts to it. I'm talking about the 30D tax credits, which means that either 50% has to be from the extraction or 50% from the beneficiation of those critical raw materials. And that goes incrementally up over the years. The issue is the language that's deployed. It's not and, it's or, right? So one of the two has to be. So you can take all your material from, let's say, Indonesia, and you have that processed in Korea, and it whitewashes that entire material, and that is now IRA compliant. It's not really serving the interests in terms of building those domestic supply chains in the US. Now, the US don't produce cobalt, they don't produce nickel, they are developing lithium assets slowly, but they are coming online. Those are meant to be boosted, and at the moment, we're not seeing that really strengthened. We obviously have now a change of administration. We're still yet to see what happens. One thing we do know is that President Trump is very anti-China. He wants to strengthen that language. So potentially we see a tightening of that language on foreign entities of concern, and that potentially could benefit any assets, whether it's mining, refining, smelting in FTA countries, but also onshore in America. The other point as well is there's a severe lack in terms of PCAM and CAM, so cathode active materials and precursor materials. We're a producer of PCAM and eventually a producer of cathode materials, but we're the only ones in the US right now, right? And every other project has also been delayed or suspended, right? So you're seeing really these pressures that these projects are facing. So we still have to see what the regulations change. Potentially we see an EV slowdown. But in terms of actual raw material extraction, that potentially could get strengthened in the US, but we'll still have to wait and see.
Okay, so I thought we could just look very quickly at, we've identified a few funding gaps that are happening over, in terms of the industry overall. But we are seeing a growing new investor. So the OEMs have been coming up really, strong as just a point of interest in terms of new sources of funding and new people that are interested in getting involved kind of at the mine site and getting those raw materials. So do you see potential for these new investors to kind of take a solid space in the industry?
I think looking at what's going on with the OEMs and the troubles that they're facing, I think, I know VW's just done a 5.8 into Rivian. I'm sure that'll please their factory workers no end. I think it's very difficult, given the state of their balance sheets, to be major players. They do need to make the investment. I'm just not sure where that that capital is going to come from.
I think it's also the skill set. So, I've talked to a lot of OEMs in terms of our project, and whilst they're all interested, they need a strategic partner to partner up with them to move that product. an OEM doesn't want to get, some spodumene concentrate delivered to their factory. It needs to go to a converter, then go into a battery, then go to... So there is a lot of partnerships happening across the space. It's not necessarily direct with the OEM.
And the reality that they have been investing a lot of money in the space because the funds were not there or were not provided by someone else. So they had no choice a few years ago just to try to lock the volume that they were asked to secure by the top management of their firms. They made, no comments, but they made a lot of stupid investment as well. A lot of them lost a lot of money, or they were investing hundreds of millions on projects, not having even a PEA or permit. So they were just looking at the PDF with the timeline and production 2027, here is 100. So they, to your point of expertise, they went a bit too far from their expertise. I feel what we will see though is that they will concentrate again more on their tier one suppliers. So I see that it will be even more closer to the gigafactories. The gigafactories may end up being captive assets of the OEMs, but going all the way to the raw materials themselves, I don't see that coming. They have their balance sheet issues, and so it's not the DNA. And formally, as a shareholder of a car company, do you want them to invest into a mine in Latin America? Probably not. That's not their DNA. So having them as partners, yes. We need visibility from them as to what type of metal they need, what type of traceability, sustainability aspect they are looking for, and that's a big part of that assessment of the opportunities. I mean, I'm sure, Amanda, you're having the same discussion. I mean, traceability from the mine to the cell, and to know what you have to comply with, you have to talk to the customer. So more than direct involvement through capital, it will be commercial involvement. Well ahead of the qualification to make sure you have the proper traceability, for instance.
I thought we could just wrap it up with a closing thought from each of our panelists about, I suppose, the state of the critical minerals industry overall, investment, thoughts that our audience of investors and corporates should take away with them as they go on to their meetings with juniors and in the networking with other investors.
I think, I guess with all things, we go through cycles. Lithium's going through, another downturn. The question, I guess, is everything turns. Simon said that earlier. It does. Everything gets better, I guess. From an investment perspective, looking at some of the smaller exploration and development plays is, what is the potential dilution that you're going to suffer as an investor before this cycle comes back? Those that are cashed up or bigger companies that can operate and still have some kind of a margin or break even and ride it out are well positioned. I think you've just got to, I think most importantly with the junior miners is look at potential dilution and if they can make their way through, because it will ultimately and always does turn.
I would probably end saying that if there's no mining, there's no energy transition, but that mining needs to be done in a sustainable manner. And I think there's a lot of focus in terms of the Chinese spot price, no matter what commodity we've talked about this morning or this afternoon. And that doesn't represent actually the rest of the world. So I would say don't only focus on that. That's very myopic. The Chinese definitely don't do that. Neither should we. I do believe that the transition to electric vehicles is inevitable. We've passed the tipping point. It may be slowed, but we're definitely on that trajectory. We just need to do it in a sustainable fashion.
For me, it's around focusing on, obviously I'm on the developing side, so great assets for one, and then the other thing is infrastructure. So if you've got good infrastructure, you've got access to roads, you're very close to port, you have easy processing, because some of these projects are quite high capex to deliver, then you at these prices you don't need much of a shift to actually be economic. The worst infrastructure and the higher cost, it becomes quite difficult. So if you're investing, focus on your good assets with a good infrastructure.
I would just echo some of the other comments and put them together. Like I was saying earlier, just have faith in the cyclicality that it will continue. if we focus on the critical mineral space as opposed to the whole wider commodity space, you've essentially come up with new use cases for commodities that no one's ever had before. And we are literally just at the start of that. We've been through maybe one cycle of it, maybe two, and it will continue, and absolutely focus on good assets, focus on good management teams, and focus on good infrastructure, for sure. But this is I would say, probably the best time to go and get invested in this space, because you look at any of the prices of lithium, nickel, rare earths, that they're all at prices where almost nobody's making money. So that is literally unsustainable. So I don't know when it'll turn up, but it will. And so if you go and find the best projects with the best management teams that are developing them now, you'll be in a good position.
Probably the final comment I will make is that we certainly need longer term capital than it was before. So we are starting a new super cycle, so probably it will take more time for that cycle to stabilize. So the time horizon of the 5-6 years that we had in mind when looking at copper mines is probably a bit too short, and we probably need to expand a bit our mindset to more longer term capital or longer term deployment. For that reason of the fact that the market is not stable at the moment, and also some of these projects are very capital intensive, so you need a bit more time probably to make sure you have a return, and it will also take more time to bring the right partners. So, but in all the product developers that are trying to raise strategic capital, in the past you were only discussing to one or two type of investors. Now I'm sure you're talking to many different investors, so everything is taking more time. So longer term view and longer term capital than it was before is probably also a requirement.
I want to thank our panelists for joining us here today.